Welcome to Level 4, Lesson 3. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about options in the stock market. Please note, this will be a difficult lesson, so please try and take as many notes as possible and learn as much as you can. So let's get started. Before we begin, it is important to define what options are generally. If you are familiar with the stock market to some extent, or keep up with social media, you may have seen some traders flaunt their thousands or millions of dollars in gains. There is a possibility that this came from options. But make no mistake, options are no easy method of trading. In fact, they are extremely risky. Options are contracts that give the owner the right, not an obligation, to either buy or sell an asset at a predetermined price either at or before the contract expires. What's important to note down here is that options do not affect stock price directly. They may indirectly influence the stock price, as we can identify the market sentiment through options, but it does not directly affect common's price. In fact, options have their own chart that is separate from the common's chart. I'm sure you're confused, so let's go ahead and break it down piece by piece. The first and most important part of contracts is understanding the key terms used in the context of options. Strike price is the price you wish to secure your spot at. If you don't understand this, I'll explain it in the next slide. Expiry is the date in which your contracts expire and become worthless. Contracts, better known as tracts, simply represent the number of contracts you are purchasing or selling. It is important to note down that one contract is equivalent to 100 commons shares. Premium is the price you pay for each contract multiplied by 100, representing the 100 shares. If you are playing calls when buying contracts, you are betting on the price rising. If you are playing puts when playing contracts, you are betting on the price dropping. The term execute means that you are actioning your contract and converting the contract into common shares. So if you had one contract and you executed, this would convert it to 100 common shares. At the bottom right of the slide, you will see an example of what a contract is displayed as. 470C, 1.75, February 27th. 470 is the strike price. C represents call option. If there was a P, this would represent put option. 1.75 is the premium cost. But again, it is important to note down that you need to multiply this number by 100 in order to calculate how much you will be paying out of your own pocket. You are not paying $1.75. You are paying $175 per contract. And finally, February 27th is the expiry date. At the end of that trading day is when your contract becomes worthless. Let's go to the next breakdown. I understand how it can be difficult to comprehend options with just words. So I've created a simple animation to help you visualize and understand greater. Let's use the example from the last slide. 470 call, $1.75 premium, expiring February 27th, with the current share price being $460 per share. This is how you would go about buying the contract. Let's say the individual on the left is you, and the individual on the right is your broker. You would approach your broker and tell them, I'll pay you $175 to ensure that no matter what happens to the share price, I get to buy 100 commons for $470 each, so long as I do this before February 27th. Your broker will then respond with, "Okay, you have a deal." You will then take the $175 premium and provide it to your broker. You will then be writing the contract, which your broker will provide to you, stating that you bought it at a $1.75 premium, a strike price of $470 per share, expiring February 27th. Let's say today is February 1st, and on February 6th, the price was now $470. Let's say on that day, I come along and I think that this particular stock will go to $500. So what I'll say is, "Hey you, I'll buy that contract from you for $2.50 premium, meaning $250. You paid $175. I'll pay you $250, giving you a $75 profit." At this point, you have two options or two choices to make. At this point in time, you would have two choices. You can either sell the contract to me and guarantee yourself a $75 profit, or you can choose to execute the contract. Remember, if you execute, you will receive 100 shares at your strike price, being $470 each. But keep in mind, the date is February 6th, and the current share price is already $470. You still have plenty of time before your contracts expire. And you would need $47,000 to execute this contract, because you would need to buy 100 shares at $470 each. In addition to that, you need to make note of this, and this is very important. Once you execute your option, you lose your initial premium of $175. You paid that $175 to your broker to guarantee to you that you will receive the commons at $470 each, so long as you execute it before expiry. At this point in time, if you did execute, you would be down $175 plus the additional fees to buy the commons. So your only option in this case would be to sell the contract to me for profit. There is a third option. However, the third option is risky, and let me explain to you why. Let's start off by explaining why choice number 3 is still a choice you can make. In choice number 3, you can wait for the stock price or the option's premium to increase more, as you have more time before expiry. Remember, the current date is only February 6th, and our expiry is February 27th, and we still have plenty of time. There are pros and there are cons. Here are the pros. If you wait, your contract premium may increase greater than the $250 that I offered you. The stock price may also increase, making executing the contract profitable rather than being at a loss. The cons, on the other hand, are simply the opposite of the pros. Your contract premium may decrease to less than $175 that you initially paid, or the stock price may move down, making execution a definite no. But why exactly would the premium decrease, and what causes the premium to decrease or increase? This is where the third part of the breakdown occurs. This is where we talk about Greek symbols. To put it into better perspective, Greek symbols are the most popular and most viewed datasets when it comes to options, as they determine the rate of change as well as the actual change in options premium. So let's go ahead and break down each of these Greek symbols. Theta represents the dollar value decay of your contract per trading day. So for every trading day you hold your contract, there is a decay involved, and that is represented by the theta. Delta, on the other hand, represents how much the option price will change for every $1 the stock price changes. Delta, however, is broken down into delta up and delta down. The delta up value represents every $1 the stock price moves up, and delta down represents every $1 the stock price moves down. Gamma, on the other hand, is displayed as a percentage and shows how much the delta will change for every $1 change in the stock price. The delta doesn't always remain the same. In fact, it is constantly changing, and that change is determined by the gamma. And finally, vega simply measures how volatility of a stock may affect contract price. From my personal experience, theta and delta are the most important when it comes to playing options. Gamma and vega do play a role, but the majority of traders look at theta and delta. Remember when I offered you $250 for your contract on February 6th? Let's say you went with choice number 3 and decided to hold and not sell to me. Let's have a look at how theta would affect your premium. Let's say on February 6th, the share price was $470 per share as we discussed, but the theta was negative 0.25. On the following day, or on February 7th, your premium would automatically drop to $2.25 or $225, even if the share price did not change. That is because the theta decay was $25 per day on February 6th. Do you notice how that is a con? Now you may have a better understanding as to how holding or going with choice number 3 can serve to be a con. Let's continue that theta example, but let's see how delta can also affect your premium. You went with choice number 3 and said, RIA, I'm not selling you my contract for $250. As a result, on February 7th, theta brought you down to $225. Now let's say delta up is plus 0.25 and delta down is minus 0.5. So far, we're still at $470 a share, so your premium price has not changed. That's okay. But what happens if the price begins to move? Let's say we move up $1 and move to $471. Well, our premium price would move up. So we would take our initial premium price and add the delta up. That would bring us to $250 a contract. Exactly the price I offered you. That should make you happy. Here's where problems occur. The delta down is minus 0.5. So now, if we move back down to $470, our delta down kicks in. So our premium would move from $250 to $200. Now all of a sudden, even though the shares price is the exact same as the start of the day, $470, your premium is down another $25. Again, do you see how holding and not selling your contract could pose as a problem? Now imagine if a stock moved up and down and up and down throughout 6.5 hours of the stock market opening to the stock market close. How would that affect your premium? Now, add the effects of gamma and the effects of vega. The final piece of the options puzzle is known as implied volatility, better known as IV. IV is used to determine the stock's sentiment. Unlike the commons chart, where we can use indicators to help us identify the market sentiment, in the case of options, we use the IV value. The IV value is used to price options premiums. But how exactly does it do this? The higher the IV, the higher the premium. The lower the IV, the lower the premium. But how exactly is the IV value determined? Well, the IV value is determined by the overall supply and demand. The lower the supply and greater the demand, the higher the IV will be. The value of the IV is simply a prediction, and this is important to note down. The value of the IV is simply a prediction as to how much percent a stock will move by the option's expiry. For example, if the stock price is $200 and the current IV is 50%, the IV is implying that the stock will stay between $100 and $300, being 50% of the $200. Now that we have come to the end of this lesson, you may still be confused as to why someone would trade options, even though there is a potential for great gains. What's important to note down here is that almost all traders go with choice number 1, as it does not require a large account, it costs significantly less overall, and the profit is there to be secured. If you are interested in options and would like to begin trading them, it is important to learn to play commons first, and it is also important to learn to chart exceptionally. Remember, the change in stock price does affect the options premium. So if you do not know how to chart or don't have an idea as to what the stock commons will do, you will not have the slightest idea as to what the options will do. What I would also like for you to do is to gain extreme confidence. Even if you have learned to play commons and learned to chart exceptionally, you may still be lacking confidence, and this could lead to plenty of failed trades. You must trust yourself and believe that you have the skill to accomplish success. When trading options, risk a very minimal amount. In fact, risk only what you are willing to fully lose. Remember, with commons, it's almost impossible to lose your whole initial investment. However, with options, it's very easy to lose your whole investment. What I would also suggest you do is quickly look at Greek symbol data before deciding which contract to take, as each contract, with different expiries and different strike prices, carry different Greek symbol values. And that concludes this lesson.